Hello, everybody, and welcome to another episode of the Secure Digital Market Rundown. For those of you who are not familiar with secure digital markets bridges the gap between traditional finance and the digital asset economy. To this date, we have worked with over 650 plus institutional clients in over 80 plus countries. We support over 40 plus trading pairs and have completed $10 billion in trading volume. We work by connecting institutions to real liquidity, smarter infrastructure, and clearer market insight. For those of you new, each week we break down the trends behind a lot of trading and what's currently shaping the market, regulations, and the overall evolution of the market structure across both cryptocurrency and capital markets. So let's go ahead and dive into what's been going on for the month of February and March. Before we get started, I do want to say that the market is probably one of the most volatile markets I've seen in the last couple of months, and then definitely the most volatile for this year. The only other time I could say it was this volatile was last year around the same time when we saw the whole tariff fiasco breaking out. But you need to understand some of the catalysts that is driving the market forward, right? There's not just one factor that has really been shifting the market, i.e., the Mag 7 has been underperforming. Microsoft down, relatively more than 20%. In a bear market, Amazon's in a bear market, and a lot of the other Mag 7s. And there's a reason for that, right? These things aren't just happening for no reason. But ideally, if you look at the overall market right now, you need to understand that there's escalating AI infrastructure spending, right? So there's an AI CapEx overspend. There's problems in the Middle East, as everybody's quite familiar, right? There's this renewed Middle East conflict tensions. And at the same time, too, there's a sharp repricing of interest rate expectations combined to drive a broad risk of an asset sell-off that you're currently experiencing in both crypto and capital markets. Equities actually, or crypto, Bitcoin has been doing relatively fine. Alts have kind of like lost their steam for some time, at least most alts. But Bitcoin, over the last week, it has been doing, pretty well compared to what the market has been doing. So the first thing I want to talk about is the AI CapEx shock. So listen, we need to kind of understand what's been going on with AI CapEx and why the market has been discounting, or at least, right, putting a lot of pressure on the Mag 7, these hyperscalers. So hyperscalers in the year 2026 are projected to exceed over $650 billion in spending. In comparison, that number was $300 billion in 2023, nearly doubling in just 3 years. At the same time, it's a 5 times increase from 2018. The last time we kind of saw some hyperscalers, start to spend a lot of money on capex was, I think a great example is Amazon. 2022, you saw Amazon spend a lot of money on capex and actually went into negative free cash flow for that year, somewhere around the summer of 2022. So one of the big reasons why this capex spending is happening is because of the AI data center build up. Right, you're starting to see a lot of these data centers being built out. There's a lot of GPU infrastructures, and at the same time too, there's long-term power and energy contracts. Just to show you kind of like the magnitude of how much some of these hyperscalers are spending. Right, you can see that Amazon for the year 2026 is roughly $200 billion. Obviously, you see Microsoft and Meta and Alphabet, right, spending $100+ million here, and right, you see Oracle typically spending the least amount of money here in terms of their capex. So again, I do want to highlight again that the combined capital expenditure is expected to top $650 billion in 2026. One of the biggest problems is the market is not sold that there is going to be a return on invested capital. And that is the big concern on why some stocks are getting hammered. Apple, for example, chose not to spend much in capex for this year. As a result, Apple is trading near all-time highs. To understand what is ROIC, this is the return on invested capital. CapEx growth is outpacing revenue growth. Free cash flow margins are at risk. Again, I talked about 2022, how Amazon went to a negative free cash flow. Again, right, market just wants to see more confidence that there is a return on investment. So again, you're starting to see that market concentration too. The NASDAQ in general, right, and the S&P, 32% of the S&P 500 is the Mag 7. And relatively 45% dominance is the NASDAQ 100. So again, the return on invested capital delivery is now mandatory. The market wants to see some more proof that there's going to be a return on this investment. So till then, it's going to keep punishing those who are spending aggressively on capex. And even in terms of capex, right? If you're going to invest a lot in capex, there's still going to be opex costs to maintain this infrastructure. It's probably like, I don't know, maybe like anywhere from 15 to 20 cents on the dollar to really maintain a lot of this capital expenditure spending. So again, you do have some risks for the long term. At the same time, too, right? We can also talk about the Middle East. So the Middle East, right? A lot has definitely happened in the Middle East, and for one, the Middle East has always had a lot of geopolitical issues, right? This is something that's not new. A lot of the Arab countries, you saw the Iraq War, you saw Iraq and Iran in the 1980s. Um, there's always been problems going on, and of course, you have right pressures in Israel that have been ongoing for a very, 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 very long time. However, escalations have exceeded farther than they typically have, right? And we're kind of going back to June of 2025 with the problems that we're seeing in Iran. So June 2025 is the last time we saw the United States striking Iran. We'll get into it. But, the current trigger we have is the military tensions between both Israel, Iran, have definitely ramped up, right? It's involving a lot of U.S. strikes, and it has raised fears of regional conflict. And those conflicts have only got worse since, right? You started to see Iran retaliating and starting to hit U.S. military bases in the neighboring countries in the Middle East, including both, well, actually, funny enough, Dubai, right, a country that has been known for a very long time to be very safe, a tax haven. A lot of businesses operate out of there, right? So Dubai, one of the safest countries, supposedly, is now at risk, right? Also, starting to see some of uh, those bombs dropping on the country. So again, those neighboring countries are getting hit at the moment, and there's a lot of tensions in the Middle East. It's driving markets. Again, there's a lot more to it in terms of what's actually causing the market to react. We're going to get into it. But if you kind of like look at markets as a whole, markets are not just reacting to the conflict, but they're also reacting to the secondary economic risks associated and driven by these trade route threats. You need to understand that once you have escalation, this leads into supply route issues. And then from there, it creates energy volatility, and then that creates inflation. What do we mean by this, right? You need to look at a very primary passageway. So the Strait of Hormuz, this is a primary macro concern, basically causing a huge risk for the market, right? The concern is the disruption of this strategical, vital trade route. So for those of you not familiar, this route accounts for 20% of global oil supply that passes through, and roughly 17 to 18 million dollars barrels of oil per day. It is the world's most critical oil checkpoint. So this is definitely a threat, and you need to understand that this disruption impacts global energy supply and shipping costs. It also impacts global inflation expectations, and also can create stagflation or recessionary pressures. Right? If you look at a graphical representation to understand the geography behind this, you can see the Middle East is here. Iran is located here, and then you can see some of the Arab countries along the Persian/Arab Gulf. You start to see the United Arab Emirates, its geography towards Iran, and its military bases are positioned anywhere along from Iraq, Saudi Arabia, and UAE. And then as you start to see these ships, right, they're starting to ship to Asia, to Europe, and it's starting to go to the neighboring countries here. So for one, the volume transported through this region, again, it's roughly 20 million barrels of oil a day, as well as you see LNG, light natural gas, is moving 290 million cubic meters, 30% of global seaborne oil trade, and then also 20% of global LNG trade is between this route. So a very significant route that connects the Middle East to global markets via the Arabian Sea and the Indian Ocean. So this is a very big deal, right? And if you start to see a blockage of this route, this is where you get a lot of inflation problems, right? You get a surge in inflation, and as a result, right, this can start to drive prices upwards for energy costs. I also do want to highlight something that I think it's very important to understand. So currently, what we're witnessing in the market is a bounce. And it's not unusual that the market does see a bounce. For one, I've cherry picked some data here. So, a couple of things to consider. So, in February 2022, the market had a bounce when you saw the Russian Ukraine war and then, slightly bullish. However, I do want to highlight, of course, if you go back to 2022, the monetary, fiscal policy, everything was slightly different. You saw more of a hawkish Fed. Again, if you guys are familiar, that is when you saw one of the most aggressive tightening cycles, right? So the Fed was not cutting, they were hiking, right? They're hiking very aggressively, and they're trying to fix a lot of the issues that was going on with, during the COVID, right? Rates were so low, and everything was just got very inflated, and it was time to unwind all of that. So the Fed started to hike very aggressively in 2022. If you guys are familiar with, or if you guys were invested in the market back then, you remember the pressures it had. Obviously, you saw Bitcoin during that time go from $69,000 at its peak around January of 2022 all the way down to 15 or even less $1,000, I believe, somewhere bottoming in like October, November of 2022. And then, of course, right, while not on this picture, I also did mention June 2025. You saw the pressures that came from the United States. It was the first attack on Iran, destroying some of its military base and some of its nuclear operations. So, again, you saw that. We're starting to see a bounce here too. So just something to keep in mind, right? But ultimately, I do want to highlight that the S&P 500. So the last time the United States conducted a military strike on Iran was June 2025. So again, that did mark the bottom, or at least a short-term bottom, until we topped in October. If you do look at October, you see we topped around there. Another really important thing to highlight at the moment is the S&P 500 is slightly below its 100-day moving average, right? You could see that it has wicked down, and it's the first time it's wicking down since May, so something to be mindful of. Obviously, if you have extended leverage at this point, whether you're trading alternative investments, you're trading equities, it's one thing to note that this might not be a risk-on environment. Even though you are getting some nice discounts in the market, the most important thing you can ever do with your portfolio today, tomorrow, is to manage your risk. And it's one of those things, if you don't manage your risk, the market will manage the risk for you. And that's something you need to understand. At any time, point in day, can this escalation get worse? And that's the truth, right? When you go to sleep and you wake up, anything can really happen between now and then. And if you're not going to sleep with peace of mind, it means you're doing something very wrong with your portfolio. Because investing should be a long-term thing, right? If you're trading, that's a slightly different thing. But if you're investing, you should be sleeping with some more peace of mind. So just manage risk here. But for the most part, we are at levels that we haven't seen since May of last year. So something to be mindful of. At the same time, too, to understand some of the asset class reactions, right? You're starting to see a big spike in oil. However, at the same time, too, commodities haven't really done much for the most part, right? Gold, hasn't really moved up much. However, energy is the first to react, and you're starting to see this the most. Again, we talked about some of the supply concerns. The energy prices rise, inflation expectations increase, and then also this creates pressure on central banks and bond markets too, right? If you start to see an increase in inflation, it can put pressure on the markets because you might not be getting those cuts in the future, right? I mean, not to say cuts drive markets forward, right? There's a difference between getting a recessionary cut too. Recessionary cuts, these are two different things. You can have a cut, right, and the market also goes down. It depends where these cuts are coming from, whether it's to stimulate the market or is it an emergency cut. At the same time, too, you're starting to see equity and risk off environment, right? Again, we talked about this. There's a lot of geopolitical instability that's pushing capital to safe havens. You're starting to see gold, more bonds, money markets. A lot of growth in tech stocks are hit the hardest due to uncertainty. I do want to note today is March 3rd. The time is 3:40 p.m. as a recording. A couple stocks are actually doing relatively well. For one, Amazon is about to close green with 20 minutes that's left. Meta is doing fairly well. The overall Nasdaq is down relatively 1%, while the S&P 500 is also almost down 1%. Bitcoin is now, on the day it's down basically 1%, and then Ethereum is relatively 2.6%. So, the market for the most part, given that the situation we're in, it has not really reacted too much, right? Again, I do want to highlight some of these larger caps have been hit pretty hard. So, I mean, for the most part, things can always get worse. It's not as bad as you think it is. Again, Bitcoin has kind of rebounded from that low of 60,000 we saw. I believe it was on February 5th or 4th of 2026. So something to really keep in mind. Now, again, there's still rate fears. Higher for longer is also another risk. So again, you see price cuts drop from 6 to also 2 to 3. The 10-year yield is holding near 4.3, 4.5. While, that's true at the same time too, I do want to highlight that the 10-year, treasury yield at the moment, even though it's been holding relatively 4.3, 4.5, mainly last year of 2025, it is getting a bit better. As of this year, it's closer to 4.06. So rates have been elevated for the most part, right? We've been in this range since 2022, anywhere from 3.7 all the way up to the 4.56 range. So again, core inflation can or is remaining stubborn at 3%. However, right, I do want to highlight that sticky inflation plus elevated rates plus this disruption you're starting to see can keep rates elevated. So one thing to really look out for. However, I do also want to talk about some valuation compression. So in terms of market mechanics, right, tech is definitely one of the most sensitive to long duration cash flows. So higher discount rates reduce a lot of these AI projections. So the requirement is tech multiples require falling yields and systematic liquidity expansion. So you can also have the risk of valuation compression. So that's one thing to also look out for. Even though things are getting better, because the EPS for the consensus for next year is EPS for a lot of these tech stocks will be going upwards. However, you can still get a valuation compression. I do want to highlight, though, that the fear and greed index, when Bitcoin had hit 60,000 or closer to last week or 2 weeks ago, right, relatively super low. I do want to say Bitcoin had hit an extreme fear of 8 before we just saw this rebound all the way up to 69,000 that we got just yesterday, I believe, and then we're currently trading at 68.4. So, it's one of these things to note that obviously that, a bear market signal is indicating that extreme fear. However, at the same time, a bear market can also indicate that you can have extreme fear. However, you do not get the bounce, right? At the same time, too, the market can have an extreme fear metric that stays relatively low. So this index basically identifies the local lows in bear markets, but not macro lows. Identifies lows in bull market, local lows in bull markets, not macro lows in bear markets. So that's just something to really consider once you look at fear and greed index. At the same time too, right, the 200-week moving average taken from last week. So Bitcoin looks like it's, definitely has had a date with Destiny here, Destiny being the 50-week moving average. 60,000, the 50-week moving average is relatively $58,000 here. Bitcoin nearly tapping that range. If you guys have been following our videos, we've been saying that the market or Bitcoin in general was headed towards a 200-week moving average ever since we lost a 50-week moving average. Bitcoin typically bottoms anywhere from 10 to 30% below its 200-week moving average, at least in the last cycle. In the last cycle, you can even see here that Bitcoin's 200-week moving average, and then you saw Bitcoin somewhere around here bottoming 10 to 30% below that 200-week moving average. And there's a lot of factors that can definitely drive Bitcoin lower at the moment. Again, one primarily being those geopolitical risks that you're starting to see in the Middle East. Those tensions are rising, and it's putting some of the biggest pressures, right? At the same time, inflation fears, you're starting to see those pressures from those geopolitical issues translate into those inflation fears. And obviously Fed concerns and tariff concerns. The tariff problems never really went away, to be honest. The uncertainty is just so high. I believe that today the world I saw this one chart. I didn't fact check it too much, but I think it stated that we're currently at living in one of the most uncertain times in history, more uncertain than 9/11, more uncertain than the Iraq War, right? So it's very unprecedented times that we're living through. And again, I do want to highlight something, right? If you're a long-term investor in Bitcoin, a long-term investor in some altcoins, right? We've honestly seen a huge underperformance of some altcoins. However, if we are talking about Bitcoin in specific, of course, this is not financial advice, but I do want to state that if you go back and you study Bitcoin's performance, Bitcoin is setting up with an asymmetric, return profile. And the truth is, the upside potentially, right? I do have to use the word potentially, is greater than the downside risk associated with Bitcoin at these levels, or near these levels at least. If Bitcoin starts trading below its 200-week moving average, anywhere near 55,000, even potentially closer to $48,000, this is where you get the maximum upside return, right? The trade would be very asymmetrical at that level. So that's just something to consider once you look at a chart like this. Not to say we can't go lower, right? It's one of these things where I've had people ask me if has a Bitcoin bottom been achieved? Has Bitcoin bottomed? Did Bitcoin bottom on February 5th, 2026? And do we continue upwards back to all-time highs that we saw in October? I'm not closed off to the fact that it's possible. I just think that at the moment we still have a lot of things to get through, right? You still have a lot of barriers to kind of jump over if you want to get back to those levels. Again, the risks with capex, market wants to see return on invested capital. You're starting to see the disruption of a lot of SaaS companies with AI, a lot of labor market. You just recently saw Square laying off a lot of people. The truth is the world is changing, right? And it's one of these things is where the market is having a hard time digesting exactly what is going on. We're kind of like in this range that we haven't seen before in a very long time. And I think that there's a lot of similarities between the year 1998 that I like to say that, potentially, right, we could be having our like, I don't want to call it the dot com moment, right? Is it the whole, the internet era? I do think technology is advancing so rapid here, but I do think the biggest concern at the moment is the labor market at the same time too, right? AI productivity is definitely very high, right? AI is getting very advanced. Claude is even, Claude and other tools are starting to be used by the United States Department in terms of defense and some other sectors involved in this too, and then even replacing jobs. Again, you're starting to see popular ETFs like IGV, an ETF that tracks a lot of these SaaS companies. You saw MongoDB down like 15% yesterday. Duolingo shattered. I think Duolingo is one to highlight, right? That stock in particular, Duolingo, is down almost 85%. Adobe, Adobe, a very popular name, right? So Adobe, even though today it's gone up, Mike, I think it was, I forget the name. Was it the guy from The Big Short? What was his name again? Not, I forget the guy's name. I have no idea. I forget. I don't know. I forgot the guy's name. I don't know how I just forgot his name, but it's okay. So, Adobe, right, at the same time too, is down 60%. So these are things to really look at in terms of the market and try to understand, where's the market relative to where it was. Sorry, the name was Michael Burry. So I just remember Michael Burry had taken a position today in Adobe. So a lot of these companies are definitely getting disrupted. However, I do want to take away, right? So in terms of the structure, um, there's a couple of things that can be said. There's two ways to look at it, right? If you want to look at it from a bullish structure or a bearish structure, not to say that the market is bullish, we'll just take the bullish structure for example. So the S&P is still near its all-time highs. Again, on the bearish side of things, you can say it's below its 100-day moving average. So that's a counter argument there. U.S. GDP growth above trend, right? That's a bullish thing. The Fed is also injecting liquidity. Um, and honestly, you can make the argument that inflation is cooling but sticky. So, anyways, I can make both arguments in the bullish and bearish direction. I think for the most part, the market is cautious. You know, in the long term, it's one of those things where I say the market, the direction of the market is for the most part, not to say it's like 100% that we know where it's going in 20 years, but I mean, truthfully, the S&P 500 20 years performance is 100% chance, according to past data, that you will make money if you stay invested for 20 years. But in terms of the short term, I do want to say the most important thing here is to be cautious and just to manage your leverage, because it's one of those things where the market structure can change any second due to the ongoing conflict. In terms of some forward scenarios, I do want to highlight. So, in terms of a rally base, right, we can start to see 60% chance. This would have to basically imply that the conflict is contained in the Middle East. You're starting to see escalations and negotiations. You also get an AI return on investment. It stabilizes. So again, I talked about EPS starting to go up for next year, and you're starting to see more on return on invested capital. At the same time here, Bitcoin new highs as liquidity returns. There's also a 30% chance of a correction. Rates stay higher for longer. You get this geopolitical tension. Again, Bitcoin resets its 200-week moving average, right? So that's one thing to consider. Again, structural shock, you get the closure of that pathway in the Middle East, or, even worse, an AI bubble triggers global liquidity crunch. So just a couple things to really look out for. I think that at the moment, not many people know the direction of the market. However, it's one thing to understand the risks affecting the market and what can cause things to get worse. So I do want to say thank you so much for watching this presentation. Once again, Secure Digital Markets, for those of you unfamiliar, we do this show basically every week, right? If you guys are new to the show, again, every week we talk about markets. We're a crypto OTC desk. If you guys are in cryptocurrency and you want to check out some of the products we offer, right, you can go ahead and send us a message. So I do want to say once more, for those of you not familiar, Secure Digital Markets bridges the gap between both traditional finance and the digital asset economy. We work by connecting institutions to real liquidity, smart infrastructure, and clear market insight. Once again, I do want to say thank you so much for watching this video, and have a good week.